Imagine submitting the perfect construction bid. Your margins are tight, your timeline is flawless, and your team is ready. Then the whole package is rejected before anyone even looks at the price, all because of a single decimal point. That decimal is your experience modification rate, or EMR. It functions as a safety credit score for contractors. It is calculated by an independent rating bureau, and it dictates exactly how much you pay for workers' compensation insurance. This scale illustrates exactly how it works. Insurers use 1.0 as the industry baseline. If your EMR drops below 1.0, you earn a discount on your premiums. If it goes above 1.0, you get hit with a financial penalty. This is a strict mathematical comparison, pitting your company's actual safety history against the expected performance of other businesses in your specific industry and size class. The math hits your balance sheet immediately. Your final workers' comp premium is simply your base premium multiplied by your EMR. This calculation shows the impact on a $100,000 base premium. An EMR of 0.75 knocks that bill down to $75,000, but a score of 1.25 pushes it to $125,000. That is a $50,000 difference every single year just from that one metric. The insurance cost is often the smaller problem. General contractors and large project owners use the EMR as a strict pre-qualification filter. To even submit a bid on commercial or government projects, you typically need an EMR of 1.0 or lower. Pre-qualification platforms like ISNetworld collect and publish these scores for clients to review. If the cutoff is 1.0 and your score is 1.01, your company is instantly disqualified. An elevated EMR operates as a structural barrier, locking highly qualified contractors out of their own market. To control your EMR, you have to look at how it is built. Independent rating bureaus like the National Council on Compensation Insurance, or NCCI, calculate your score using a rolling 3-year window of your claims history. They skip the most recent policy year because that data is still considered too fresh. This diagram illustrates the core of the actuarial formula, a balancing act. The bureau compares your actual losses, the real claim dollars your company generated, against your expected losses, which is heavily determined by your total payroll size. The larger your payroll, the larger your expected losses. That high payroll acts as a mathematical buffer. A large contractor can absorb a sudden spike in actual claims without their EMR tipping very far. A small contractor doesn't have that buffer, meaning a single incident can cause their score to spike. The mechanics of this formula are shifting. In 2024, the NCCI rolled out a major update to how it categorizes claims. Previously, they used a flat nationwide dollar threshold to split claims into primary and excess categories. Now, they are setting dynamic, state-specific split points based on localized data. They also introduced a new loss limitation set at the 95th percentile of a state's claims. This acts as a cap on shock losses, ensuring that massive, multi-million-dollar outlier claims don't destroy a contractor's rating. Your EMR is generated by a heavily guarded, data-driven system, where the precision of the payroll and location data you report dictates the baseline risk you are graded against. When evaluating your actual claims, the formula operates on a very specific rule. The frequency of your claims damages your rating far more than the total severity of one big claim. As this scale demonstrates, 10 small claims costing $3,000 each heavily outweigh a single $30,000 accident. A pattern of frequent injuries points to an unmanaged systemic hazard in your operations. A single severe claim is viewed as statistical bad luck. To penalize that frequency, the formula applies the maximum mathematical weight to primary losses, the first dollars of every single claim. When you have multiple claims, those heavily weighted primary dollars stack up quickly. But workers' compensation costs fall into two distinct buckets: medical only, which covers doctor bills, and indemnity, which pays for a worker's lost income when they miss time. Under the NCCI system, there is a massive incentive to keep claims in the medical-only bucket. If a claim remains strictly medical-only, its primary loss value is reduced by 70%. Aggressive claims management has to start today. The most practical tool for this is a strict return-to-work program. When an employee is injured, you must place them on modified or light duty the moment a doctor allows it. By keeping the employee on your payroll and returning them to the job site, you avoid triggering workers' comp indemnity payments. The claim stays medical only, and you capture that 70% discount in your next EMR calculation. You also need to audit the data your insurance company uses. Insurance auditors frequently make classification errors, like incorrectly grouping low-risk clerical hours under a high-risk code like roofing. When your payroll is underreported or misclassified, it shrinks that expected losses buffer. Without that mathematical protection, a minor claim will cause your EMR to spike unnecessarily. Your EMR is a competitive weapon. Audit your payroll reports, keep your claims medical only, and protect your right to bid. For more strategies on optimizing your operations and safety metrics, subscribe to the HSE Study channel.